Hey, Dr. O, your column runs every Monday in the Center Square. It's the Everyday Economics column where you're looking at the week ahead and what's going on. We have news today that's gonna certainly inform what goes down next week. The personal consumption expenditures price index, which is by far the Federal Reserve's favorite measure of inflation. It came in at 2.5% up on an annual basis for January. Not necessarily great news. However, in line with what we've been talking about, where maybe 3% becomes the new norm. Let's start with that and go from there.
Yeah. So, look, the headline numbers, it came down. Headline numbers, 2.6% higher than 2.5% higher than a year ago. A month ago, there was 2.6%. Core inflation eased from 2.9% to 2.6% year over year. And that's because inflation was coming down a lot. This year, I think inflation's actually, increased a little bit. So on a month over month basis, you're at about 0.3% month over month. So relative to last year, things are looking quite good because it's easing. But in the last couple of months, we've had kind of a small uptick, right? So the question is, are we going to be kind of settling around this level, or can we expect further disinflation?
Mm-hmm. Well, it's to level set. It's slowing, right? Okay.
Yes.
But it's still, 2.5% above where we were last year.
It is pretty stubborn. And it doesn't seem to be moving fast enough towards the 2% target. And the reality is that perhaps the Fed should be happy with this result, because getting it to 2% could mean applying the kind of squeezing the economy a little bit further, right?
Mm-hmm.
And perhaps it doesn't want to do that. And here's why I don't think it wants to do that. Doesn't want to do that because the policy climate, or at least the uncertainty surrounding the policy climate, could actually already be applying the squeeze for the Fed, right? Okay. So when I said this time and time again, when people are afraid about what's going to happen next, when business leaders cannot forecast what's going to happen next, what do? Well, they just stop investing. They stop hiring people, and you end up having a cool down in the labor market. Consumers also stop buying big ticket items, and then they just go to turn completely to value and try to save as much as possible. They sit back on their wallets. And so all of that tends to slow economic activity and could result, of course, in the labor market cracking, essentially, right? So I pay attention to that very carefully. Next week, we got the jobs report, and the jobs report for the month of February is going to be a big one, because ultimately we didn't have a winter freeze in February. We didn't have the seasonal factor adjustments in February. So we finally get a month where we might actually start to see a little bit less noise, right? And so I'm a little bit, I shouldn't say worried, because unemployment claims are still below where they were back in, say, November 2024. You look at the 4-week moving average of continued unemployment, continued claims, basically lower than it was in the fourth quarter of 2024, but higher than it was most of last year before, right? With the first 3 quarters of the year. So we've had a shift up in the number of people that are staying unemployed longer. You look at initial claims, the flows into unemployment, and a good proxy, because those are people who actually go out and try to claim benefits. Initial claims, are lower than they were, in the fourth quarter of 2024. And also lower than they were for most of the year. So it is essentially people are staying unemployed longer. They're not able to find a job, but the flow into unemployment, the number of new people going into unemployment has kind of slowed compared to last year.
Yeah.
Right. And so, are we going to, like this past week, we got a sharp uptick. Is that going to continue?
How about Doge cuts, though? I mean, the Doge cuts are going to start to take place. And, I mean, as you and I talked about the jobs that were added, in particular in the last couple of years, during the previous administration, during Joe Biden's term, there were a lot of government jobs that were added. I mean, as we went through the jobs reports, I kept saying, time out,
yeah,
because there's a lot of government jobs that are filling these roles. Well, these government jobs are going to come off. I don't know how quickly they're going to come off.
So it's interesting you say that, because I was saying the same thing. I thought there were a lot of government jobs being added at the end there. But ultimately, when you look at kind of like the longer term picture,
yeah,
what I've learned is that, government jobs were actually just catching up to where they were before the pandemic. When you look at total government employment,
on a percentage or basis,
no.
Or on a total headcount basis?
I just look at total government jobs.
Okay.
As a share of total employment.
All right. Yeah. Okay. So a percentage of.
And the percentage of government jobs in the economy has been shrinking, actually.
Okay.
For a long time. And the only few times it peaked were during recessions. So, it's interesting because, if you focus on, government jobs are increasing at a rapid pace or increasing faster than the rest of the economy, but you only look at that period of time, then you're like, oh, hold on a second. Does that mean the economy is really weak and that we're just adding government jobs? Right? If you look at the long run period, what you realize is that actually government jobs were actually just catching up from where they were before.
Right.
And so it's weird. But anyway, I think that's not the point. I think the point is that the economy was the labor market was kind of stuck in place already. Right?
Mm-hmm.
Like low hiring rates, low quit rates, people not quitting their jobs because they don't have a lot of opportunity.
There's nowhere to go. There's nowhere to go.
And now, but layoffs remained low. But now, all of a sudden, you get an uptick in layoffs coming from the government sector.
Mm-hmm.
Right?
Yes.
To make it even more difficult for people who were already unemployed, struggling to get back to work. Right? Because now you have more unemployed looking for a scarce number of job openings.
That's right.
And so the duration of unemployment is just going to extend.
That's right. It's going up. Hey, one last question. I mean, so next week, on the calendar, Fed Chair Jerome Powell is going to talk on Friday, and what do you think he's going to say? I mean, he has to comment obviously on what's in front of him. I mean, that's the expectation anyway. What if you're Jerome Powell? What do you say next week? Let me ask you the question that way.
You're on hold. You're still on hold, but the policy climate, or at least the rhetoric coming out of Washington, D.C., has to have you a little bit worried that things could be cooling faster than expected, and that you may actually have to cut interest rates, which is, the opposite of what everybody had been talking about. Like, you start to get growth fears in the stock market, people worried about growth. You start to see the continued unemployment case starting to swell up because the duration of unemployment is increasing. and people are not, those who are unemployed today are not able to find work. And now at the same time, that could get exacerbated by a big flow of people coming from government jobs that they just recently lost.
Uh-huh.
All right. And so the labor market slack, right? The labor market is loosening. It could loosen faster.
Mm-hmm.
Right. Remember, the Fed has always put more weight on the labor market than the inflation number.
Mm-hmm.
And so I think Powell, he might not say it, but I think the FOMC might be starting to think about this a little bit more. And what that tells me is that potentially we still get more cuts than expected in 2025.
Interesting.
And so things are changing really rapidly. At one point, everybody was focused on inflation.
Mm-hmm.
But the reality is the uncertainty is causing people to sit on their wallets. And then if you add to that government layoffs, you have a looser labor market.
Mm-hmm.
You have the potential for the unemployment rate to start ticking higher.
Mm-hmm.
And then you have a Fed very sensitive to the labor market, likely to respond to that by cutting sooner than the market currently expects. And so we'll have to watch out for that. But yeah, I'll be interested. I'm very interested to see what the jobs report is going to show this month. We may not see it yet, but subsequent job reports might reveal some slowing. I'm starting to feel it a little bit in the housing market too. I'm looking at the housing market data and I'm starting to feel it a little bit. It's coming in slightly softer than I would have expected.
Well, let's call it good there, because I want to isolate and talk about the housing market. And I also want to talk about immigration this week. And then certainly, we'll be looking at jobs, next week. So let's just pause right here.